Hello, trustees. Can you hear me?
Yes, sir, we can hear you. The meeting will start shortly.
Fantastic. So this is Adam Levinson filling in for Anna today.
Thank you.
I don't think that's gonna get any easier. She usually makes these, so we'll give him another minute or two. He may know it's bad news, and man, I want to hear what you got to say. On a positive note, I'm told that this weekend's supposed to be good. Prior to. I'll take it. Yeah, about you? What the weather's showing. But Jonathan, while we're sitting here waiting for a couple more minutes, given the fact that I'm planning to put a little more dirt on my driveway, which is 360 feet long, you know,
Right now.
Steve, is that gonna talk to us about development? Hello? Yeah. Okay, so if I could, we'll call this meeting of the General Employees Pension Board or Retirement Plan Board to order. Can we have a roll call, Ms. Jill? Here? Here. Here.
Here. And there is a meeting at 5 o'clock, so we really need to be out here 10 minutes too.
Okay. Oh, yeah, that's the Historic Preservation Board, right?
Yes.
Okay. So we will do our best. So the next order of business would be approval of the minutes. Does everybody have the opportunity to review the minutes that I believe were provided?
Motion to accept the minutes as written.
A second.
Second, any discussion? If no discussion, then all in favor? Aye. Any opposed? It will be shown then as unanimously approved. And then number 3, Mr. Chambers, DCA report. Serious today, folks. You notice he left his seat at the table and has gone to the podium.
Well, I feel better standing up, and I'm an easier target for you, so. Everyone has the materials. First of all, we're gonna go over the report for the quarter, and then we'll talk about the private real estate investment recommendation. I should add that Anna, your counsel, and along with Joe were very helpful in getting the documents reviewed and prepared for you today to execute if you so choose. So let's start with the bad news. But let me set this up. Sorry. Page 1. I'd like to use the 1970s as kind of a backdrop for what's happening right now, except there's a very big difference with all this inflation. In the 1970s, we had a gold standard was jettisoned, and the dollar just completely collapsed. And it was such a dramatic collapse. You weren't even born then, were you? It was a very difficult decade. Jimmy Carter took the helm in 76. At least after the election was, and so he took the helm in early 77, but inherited a real mess. But the dollar was on its back. Paul Volcker, the Fed chief that he actually appointed, eventually took interest rates way up to pick the dollar up. This is what's different this time. The dollar is very strong. In fact, the dollar is hitting new highs every week against the yen, 25-year high, the euro, a great time to go to Europe, and Japan if you want to go to Japan. It's very expensive there normally, and the sterling. So what gives? We got a strong dollar. You know, if we didn't have this strong dollar, inflation would be really bad. Talking about 8.5% inflation. In Europe, it's only about 3%. China's inflation is only about 2.5%. Why do we have so much inflation here? It's all stems from what Congress did and the Fed did in the last 2 years. Raising the national debt from 23 trillion to 30 trillion in 2 years. And the Federal Reserve had to get in the game, raising its balance sheet from 4.5 trillion to 9 trillion. All of that money finally arrived. So we have this enormous amount of nominal gross domestic product, GDP. It's 1.4 times the 40-year average. That's how much speed this super tanker has right now out on the river. It's never been this fast in 40 years. It's 1.4 times the 40-year average. All that fuel finally got to the fire. So when you take that number, that big fat GDP nominal number, and subtract inflation from it, you get the real GDP, which is negative. So they're telling us that we had 2 negative GDP quarters, first and second, only because inflation's high. If the inflation were to come down a couple percentage points, we'd have a 2% GDP, real. Are we in a recession? I guess it depends on what you do for a living and what part of the economy you're in. But do you see it in your world, the recession?
No, there's still a lot of money around out here.
There's a lot of money around. People with means aren't being affected by this. It's people who don't have the means who are really going to get hit or really get hit the hardest. I noticed that if you buy steak in Western North Carolina, the cost per pound of the same prime quality is 30% cheaper than it is at Publix. I don't know why, but food prices vary from Milam's, not Milam's, but Ingles is cheaper than Publix. You shopped at Ingles, haven't you? You shop at Ingles up in North Carolina? Okay, it's cheaper meat than here. I don't know why. So that's what we're up against. But finally, let me say this to you. The problem with a strong dollar that's getting stronger and stronger is it causes countries that have dollar denominated debt. There's a lot of countries in the world that borrow money in dollars. They're going to default because they don't have enough foreign exchange. They don't have the means to pay off those debts. The dollar's gone up too much. It's almost like you've got $1 million loan that's now 1.5 million. It's becoming a bigger loan because they have to convert their weak currency into a strong dollar. So that's bad for the developing world. And frankly, it's bad for countries that have to import things that are like oil that are pegged to the dollar. So I think there's a bluff here, and I think the Fed is going to end their increase tomorrow and for the remainder of the year. And I guess they're hoping we'll see something favorable happen with a downturn in inflation. But the Fed has no business taking the Fed funds rate beyond 3.5, 3.25%. It's 2.5 now. You take it up tomorrow, 0.75, that'd be 3.25. To take it to 4.5, which some people are talking about, I think is really irresponsible. I don't see them doing that, but that's my hope. Next year, I haven't talked about the bad news yet. Next year, if the economy does start to feel all of this weight of these tightenings next year, because it takes a while, then the Fed has in its toolbox the ability to lower rates again. And they can do open market operations again and buy mortgages and bonds and bring down interest rates. So they have quite a bit to in their toolbox, but the key is to get the inflation down. That's what they're trying to do. And it's going to hurt us here. It's going to hurt the stocks, and it's going to hurt the bonds. Now, not since 1994 have we seen stocks and bonds go down precipitously. Bonds and stocks generally move inversely. So this has been a kind of a double whammy for pension plans, and anybody who has a balanced account, both their stocks and bonds have gone down quite a bit this year. Bonds are down about 10, stocks are down about 20 since January 1.
When do we get out? Do we bail out after a short time here to continue? Say the elections don't turn out like we want in November. It's best to get rid of a lot of the stocks.
Well, that's a good question. It's a question a lot of people have asked historically when we have downturns. This reminds me of in May of 2009 when it was a bloodbath. That downturn, as you recall, actually ended on March 25th of 2009. A couple months later, you were on this board then. You asked the same question, sir. I urged you not to take any action. The thing is, the market did come back, and it came back with a vengeance. The problem with timing the market, I hate to sound trite, but it's true. You don't know when to get back in. And when the market comes back, it comes back with a vengeance. It's a tectonic event, and it's over before you can even figure out what day it is. So you're better off just riding through those tough periods the best you can. The reason why we're talking about private real estate in a few minutes is because it is one area that has an inflation hedge component that I'll go into some detail in a minute. I know you're going to have some good questions. as to why it makes sense to just tap more into real estate at this time. So before I go through the summary, let me take you up page 15. I had a conference call this last Friday with your large cap value manager, Mills Riddick, Sarah Dex, Don Wardell with the mid cap value product, and with both of those guys, and with the small cap value, it's an Orlando-based firm. But just across the board, results have been pretty harsh. Voya large cap growth. The only reason they didn't really do better is because they're underweight to Apple. They have an 8% underweight to Apple. The index has a 14% weight. That's the primary reason for that underperformance. But if you look at Mills' large cap value product, they didn't buy the oil story. So if you were underweight in oil this year, you look pretty dumb. They didn't believe in it. They didn't believe that the oil thing, they didn't really believe Putin is really going to do what he did. So their underweight to oil has hurt them this year, and those underperformance is reflected in the 12-month figures. The Fidelity Mid Cap is as an index product. The Mid Cap Value, that's Don Wardell's program. Same thing. He doesn't like energy, and he'd rather invest in materials companies, companies that he believes will benefit from the build out of infrastructure in the United States. A small cap growth is another index product, tech oriented, and that's why it's down so much. By the way, for a client, we recently looked at the question, why do we even have international? And international has underperformed U.S. stock, large cap stocks for 14.5 years now. It's the longest consecutive period where U.S. stocks have outperformed. Anybody have any idea why? Well, I didn't tell anybody in advance, so Jill knows, but the reason is technology. The U.S. has been the premier technology leader in the world. I mean, in 2020, for example, the top performing stock was Tesla. In fact, you know, that kind of phenomenon has just permeated the large cap growth names, and they're pulling back this year. Tesla, 1-year number is positive, but their year-to-date, they're up 22, 12-month rolling, but their year-to-date number is still down about 18% since January 1. So we've seen a pause in tech. So anything that says growth next to it, whether it's large, mid, or small, has been adversely affected by the pullback in technology. I thought you'd ask the question, why do we have international? Should we talk about that? So, U.S. stocks are selling at about a 19 multiple to earnings. The European, Australian, the EFI index is right around 9, selling at a 50% discount. You have an underweight to international right now. Our view is international will come back, especially when the Ukraine thing is finalized, and hopefully we're on the winning side of it. Europe's going to benefit tremendously from the rebuild of Ukraine, Germany in particular. Germany, Italy, France will get a lot of bang out of that recovery. So we think it's, and the dollar's getting stronger, so the time is not really good to rebalance back to international. I should add that Cohen & Steers has worked out for you. It is an equity. It's the only equity here that with a positive return fiscal year to date and for the year. And it's because it's a deep value proposition. It contains companies like towers, water plants, railroads, that kind of stuff. That's stuff that's really stable throughout the cycle. They were very worried about that railroad strike because right now we're moving a lot of coal around the country to make up for the high cost of nat gas. They burn a lot of coal over here at Seminole. And I think that's all they burn. They burn nat gas there, or is it just coal? So on a BTU basis, coal is much cheaper than gas, and so they move it by rail. So that strike that Biden averted last Friday would have really put the hurt on the U.S. economy. All that coal, just the coal. There are all kinds of obvious things that are moved by rail. Fixed income is a bright spot. Well, let me talk about American Funds, Euro Pacific. Underperformance sort of stabilized for the quarter, equaling the index. And we talked about this last time, but we like the firm very much. Still, their underperformance in 2 consecutive quarters. Fourth quarter of last year and the first quarter of this year, in emerging market exposure, primarily China, bit them pretty hard, and that's why they. But if you look at their longer term numbers, you can see they're still in the index. On the fixed income side, something that has worked out for you. You can see of the 8 million, a little over half of it's in the 1 to 5 short-term bond fund. You can see how much better that has performed. It has a much lower duration, it's less sensitive. So as rates do start to move up, as the yield curve does move up, this fund will capture those increased yields much quicker than the total return bond fund, which has issuance going out to 10, 12 years. You do have some exposure to high yield, but it's small. It's a little over 10% of the fixed income piece. The summary of the written remarks are on page 4. I should add that the Florida retirement system they moved their I think they're down to 6.75 now is their long-term return objective. So they're moving theirs down. They were one time they were 8, and then went to 7.5 and 7.25. Now they're down to 6.75. With that, I'll take a pause and see if you have any questions.
So let me just make sure I'm looking at the right pages. So we're looking at the plan being down 2.2 million or 10.4%. 10.5 net. Correct?
Yes, you see it on page 8 too.
And then for the 1 year, it's down 13.9%. Actually,
14.3
net.
Yeah.
Is that correct?
Yes. I should add that the actuary does I believe it's 4-year smoothing. So the actuary will take 1/4 of this year when it wraps up in a few weeks, and they're only going to capture 1/4 of this negative experience. They take the last 4 years, the average of the last 4 years. And so they're going to add one of those. Last year was a great year for you. So they're gonna take one of those, 1/4 of that return that year and add that to offset.
So-
that bad year.
So, and I remember to turn my mic on, Jill, so I get a plus, put a star by it.
So the city's not gonna get hammered all at once. It's stretched out over a period of 4 years.
In terms of us having to increase contributions, you mean?
Yes.
Okay, so, and I know nobody has a crystal ball, but what does the conventional wisdom say that, how does the conventional wisdom say you approach what we're seeing right now? You say there's some anomalies that, or let's just say some trends that aren't typical with bonds and stocks going down at the same time. The dollar being super strong and yet, so I guess I don't have a lot of confidence in people at the top fixing this. As you said, their moves, putting a lot of money in circulation, the Fed, also the Congress, kind of put us here. So if they had that sound wisdom and approach to our financial market, some of the pressures that put us here wouldn't be in play. Agreed? So how do you put confidence in those same people to fix it?
Let me ask you something. The Federal Reserve has $9 trillion in bonds and notes in its portfolio. When they mature, they get cash, right? When a bond matures, you get paid cash. You know what they're gonna do with that cash? They're gonna burn it. All that money that comes back from those maturities, they're gonna burn, destroy,
You mean burn literally?
literally take out of the system. Problem is, the system is too loaded up with money. Okay?
What guarantee do we have that they're gonna do that, though?
No, they've said they're gonna do it.
Okay.
But the unwinding is not gonna happen all at once. It'll take years.
Right.
Now, if they wanna force the issue, and start pushing, more and more stuff into the market to buy it, that's gonna push up rates even faster. So they're not using that mechanism yet. If they're gonna use it, that's how they're gonna raise it. The whole yield curve is gonna go up. You'll see the 10-year, go to 5.5%. It's been there before, actually.
Sorry, I'm getting.
It's okay. Mr. Holmes has no confidence in leadership. The thing is, this, you get called up in the wheelhouse and you're driving this big super tanker across the ocean and it's going real fast and you have very few ideas on how to fix this thing. It's that big of a problem. Now, in spite of all that, there's a lot of confidence in the United States. That's why its dollar is so strong. The Japanese savers are investing in dollar-denominated investments. You have money flocking over here from Europe. And of course, we know that money is coming over here from Latin America at a very high rate of speed. Argentina has an 80% rate of inflation, 80. It's a mess.
How do you live with 80% rate?
I don't know. I don't know how you live. And people are afraid to keep their money in the banks because the government is known to abscond with their money. And that's why you have Bitcoin. That Bitcoin is really for people like that, frankly, to transact things and not be where it's not detectable. But our neighbors to the south, and even Brazil is not immune from this, are getting pounded by inflation. Now, the US did a really good job in creating this mess. But when the pandemic started, it was all hands on deck. They didn't know where this thing came from. At least they're not telling us. And they didn't know how to stop it. They didn't know how perverse it would become. And I should add that $50 billion of the PPP money went to the airlines, and they use that money to buy out pilot contracts. I thought that money was supposed to be used to keep people employed, not lay them off. So the Justice Department is going after the airlines right now. Hopefully they're going to get some of that money or all of it back. It's ridiculous. But to answer your question, uncharted waters. But we do have inflation here. It's real. It's not going to go away this year. It's going to bleed into next year, this inflation. Now, for some people who have the means, they'll become very wealthy. For other people who don't have means, inflation is a terrible tax.
Okay, let me ask you another question. Let's say you were czar.
Putin? You mean I'm the czar?
You're the czar. You're the economic czar in America. Okay, what do?
You don't pay me enough.
You don't pay. I don't pay you enough for what?
to answer. That's a joke.
Really?
I'm not sure. I think I would have to study that question to give you an educated answer.
Now you're going to sit here and tell me that a thinking man like you over a drink at night on the weekend
Now, drink is
hadn't thought about what would I do if I were God right now in this scenario?
Well, personally, I am land heavy. I'm dirt heavy right now. And I have a lot of cash. Personally. But this is a long-term proposition here. We've been through this before when you were here last at the big downturn in 08, 09, you were here. And you're part of the 8 team that weathered that storm. The city will undoubtedly have to contribute more money here over the near term, but it's anybody's guess how quickly this economy will recover from this malaise.
What do you see a recovery being? When we say recovery, what do you see that? What does that look like? Recovery?
Well, to me, recovery means that the labor market imbalance is somehow fixed. That's going to happen either because kids finally decide they want to go to work. Well, I can't fix that. I got a 27-year-old still at the house. Can't afford to rent an apartment anywhere in Orlando. And I'll stop with this question. I'll stop with this question, but sure.
We're all fighting, and we see at this level the wage issue that we're all fighting. I guess Florida's $11 an hour. It went into effect. Is that today? It's $11 an hour minimum wage. It goes into effect right now or next week or sometime. But $11 an hour is a joke. If you're going to keep employees right now, you can't do it at 11 an hour. You can't do it at 13 an hour, quite frankly.
No.
And I'm talking about even in our sector. I'm not even talking about in the professional ranks. And yet, even when we pay more money, we can't seem to attract the numbers that we need to go around. So people are constantly rating other people. And I talked to you about that a minute earlier.
Around my office, trying to keep people.
So you've got these forces at play in the real world in terms of the employment market, where government's having to pay more money, and government has to deal with that one way or the other, taxes or whatever. But the private sector is having to deal with it. And the only way private sector has to deal with it is to raise prices or else take less profit. And anybody that thinks that private sector is going to willingly take less profit, especially those where they're having to please stockholders, is fooling themselves. So how do you get the wage component of this inflation under control?
Well, I was in college in the 1970s, so I don't remember how hard it was, but it was hard on a lot of people in the 1970s. I mean, prices went up everywhere. And I don't know how we got through that period. I do know this, though, that we went through a horrible recession when Reagan took over. In the very beginnings of that, the recession was in full force. And what Reagan, but see, it's a different setup. you had high unemployment. We have virtually no unemployment right now. They can't, when there are job openings, there is need for people and they can't find them. It's a very curious time we're in. How do you get people to work?
I don't know. I'm asking that
I don't have a good answer for you. Maybe we have pay more money, maybe parents have coddled their kids too long. I mean, my dad kicked me out so quick. My daughter's a federal prosecutor now in Ashland, North Carolina. I had her in the house for, believe it or not, in mid-20s, getting through law school and getting the bars behind her and stuff. Maybe the parents have just been too easy on these kids. I don't know. Allow them not to go out quicker. We also don't have the military is a very small part of our employment economy. There was a time we had a lot of people in the military. They had 3 squares a day and they had a place to live for free and they make a lot of money, but they were doing something. We just don't. So there are a lot of changes this time around.
That's the thing that scares me, Mr. Meredith, is Mr. Chambers is sorry, I didn't mean to make you a movie star, but
What did you call me?
Meredith, Burgess Meredith. I was wrong. Chambers, I said.
I thought you said Steve McQueen. Go ahead.
Well, we can all, dream. You got a 67 Mustang? No.
Green? No.
That's the part that scares me is I see, and I'll stop. This is philosophical more than anything else, but I see dynamics in America, in the world right now that I've not ever seen. When I was raised, the whole deal was get up, get a job, go to work. It was not just a thing of you needed money. It was a thing of ego and pride and self-esteem. And you know what I'm saying? You got a job because you needed to have a job.
You're independent.
Exactly. And I don't see that same driving force right now with a lot of people.
I don't know how this started. Maybe it started with giving kids little games when they were really young and so they wouldn't bother you. I don't know. Maybe it started when we stopped having dinner together as a family. Maybe it stopped. I go out to dinner and I'll see a family, the mom, dad, and the 2 kids, and they're all doing this. They're not engaged. I don't know where it started. Technology. I don't know. But I will say this though, on a brighter note, there are immigrants coming into this country from Ukraine, from Poland, from Central America who want to come here and they want to work. And every job site, I'm building a house in Savannah right now. No one on that job site except one guy speaks English. Now that's my fault because I never did well in Spanish. But there are a lot of people who want to come to this country and they work hard. And there's plenty for them to do. And there's some really brilliant kids, families from Ukraine who are coming here. And you're going to hear more and more about this. We need them. We need them desperately. So there's a silver lining there. Also, Germany, which has been the locomotive of Central Europe for decades, is in trouble. The high energy costs are rattling their industrial might. And more German companies than you could imagine are looking to relocate out of Germany. And the United States is an area that they already have a footprint here. But Germany, France, and Italy, all 3 of those countries, companies within those countries, I know this because I know guys in the business who are talking to these companies. They're looking to relocate more and more operations here. Problem is we got lack of labor. They can you can build a factory here that makes automotive components and only have about 5 or 6 guys because it's all automated. You don't need 50 guys anymore. So there's a lot of automation that's going to continue to increase. The Chinese are actually having labor problems. I don't know if you're following
The
that.
Chinese are having labor
Yeah,
problems.
the COVID You know, they've been draconian about COVID. They are just, they're shutting down cities and they got military people with machine guns walking around the streets. Can you imagine that in Palatka? Telling people they can't go to work. They've have factories have closed, and now when they've opened them up again, they're finding that they don't have the people that they once had. And so they're automating more and more, and we're automating here, have for a long time. So there is going to be a continual renaissance of economic reinvestment in the United States. And I just hope we have the labor force to be able to pick up the slack, because we don't have enough labor right now for what we're trying to do. Labor is a big part of this problem with inflation, and so is the cost of housing. Cost of housing is the biggest component in the core inflation statistics. And you know, I've been hearing about shortage of workforce housing forever, decades. And now it's a big deal? Come on. It's been a big deal for a long time. Now, Denver used, I don't know if they still do it, but they used to build these dormitories for, like, let's say college age kids who work in restaurants and so forth in the city. The city would own and operate these facilities. They were nonprofit. And they would, this would help kids, you know, trying to get started in jobs that were desperately needed in Denver. So I don't think we're doing that here. Now, Miami has, in Palm Beach County and Orange County, areas I'm familiar with, are doing grants and so forth to encourage workforce housing in areas of the town that they are trying to reinvigorate. But these are for-profit organizations that are doing this. The rent's still pretty expensive. You're familiar with that here.
Yeah, we are, and yeah, I don't know.
I wish I had an answer for you.
I was mentioning to, I think Jonathan, maybe not, but I was out in the Yellowstone area a couple of years ago, and was in an area that's on the northwest side of Yellowstone, a little town up there, and they had an ordinance, local ordinance, where you couldn't get a business license unless you could, at the time of application, show where your workers were going to live. You had to provide either a lease, you know, you have a less interest, lessee's interest in property, or you had to show where you had bought property so that you could show where it was Jackson Hole, actually, where you could show where your people were going to be, because they were so over the idea of their workers not being able to live in the county, having to come over the mountain from another county, and then when the weather was bad, they couldn't get there. So you had stores that weren't open, et cetera, that they just flat said, no more. If you won't get a business license to open unless you can show us how many employees you're going to have and where they're going to live. I thought it was amazing. I was talking to a bar owner, and I mean, he was a very bright guy. He had a nice little bar there. I'm not talking about a dive. And he said, yeah, he said, I had to show, I had to get leases on X number of pieces of property in order for me to be able to open, so I could show where my people were going to be, which I thought, yeah, that sounds a bit radical, but you know, right now we're in a situation where we're going to supposedly have 2 marijuana grow, processing, and distribution, or processing and shipping facilities open. Each one of them is claiming, if you believe them, 100 to 300 jobs per facility. I have no idea where they're going to live. I have no idea where they're going to get 400 workers in Palatka or Putnam County, Florida, to fill those jobs. They got all the money in the world. And if you know, they got all the money in the world apparently, but I don't know where they're going to get the people. Don't know where they're going to live if they get them. So workforce housing is that's an interesting concept.
We'll go out to Hot Springs, California. I visited their green zone out there for a client that ended up investing in a marijuana operation. It's in the middle of nowhere. It's a horrible, you can't imagine anyone lives out there. And they have these facilities that you're talking about. And I don't know how the people get there, but it'd be interesting to use some of those areas just to go out and investigate and see how their big issue out there was power. Getting the electricity secured long-term so they could operate 24/7. That was their big concern, not labor. But I don't know where those people out there live.
But what you're saying is that, well, I won't go there. It's just, if the market doesn't figure out a way to make housing available, you're almost going to have to see major employers either one, locate the places where people have moved from, like the inner cities where there's space available, or else you're going to be seeing employers investing in some form of housing. And it may not be a apartment building, but it's going to be some form of housing where I offer you, I want an employee, and I tell you, and if you need help for the first year getting a place to live, I've got it for you.
Well, these employers have a vested interest in keeping their turnover low. And if that means that they have to pony up and invest in such a facility, it's in their best interest.
Yeah.
I don't see any reason why they would believe me, these things make money.
What are they doing with the money now? In other words, the Fed still won't take the money, will they? The federal insured bank still won't take the money?
There are state banks that will take the money. The money part of it hasn't been completely solved, but most of it has been solved. There are companies that will take the money on pallets. You believe this? Cash. It's like a movie. And it's like I don't know, it's a crazy thing. But they will take this cash and they have the machinery that will process those bills and get them all straightened out, whatever, and counted.
I don't mean rude. The mayor's texting me. I just need to text him back, tell him I'm busy.
He's probably hunting me down because he wanted to meet with me after this meeting, but I'm trying to talk so much.
No, I distracted you. I got off on the side because I think about these things and I don't have the perspective that you have. And I'm just.
But I would urge you to go out, take a trip out to Hot Springs, go out to those green zones and see how they're handling their workforce. It's worth a trip. Wait until it gets a little cooler.
Yeah.
But that'd be worth it, going out there to see what they're doing. But electricity was their number one problem or challenge out there.
I just got back from Denver. They're handling it by building vertically everywhere you can find. Arvada, all the areas right around Denver are just, you can't go a block without seeing new construction.
But it's expensive.
Oh, yes, sir, it is.
Well, you want to talk about real estate?
Okay.
Okay. All right, this supplemental piece that Jill's going to put up on the screen for you. I want to first take you to page 8. This is a correlation coefficient matrix. And if you start at the top left where it says private real estate above U.S. bonds, you go across. That's the only area I wanted you to look at. Those numbers represent the correlation. For example, bonds, U.S. bonds have a negative correlation of 20% negative correlation to bonds. To private real estate. And of course, bonds are going down in value right now. So private real estate historically would be expected to go up in value. The S&P 500 has a 15% correlation. These are very low correlations. 1.0 would be a perfect correlation, perfect match. The small cap 2000, only a 9% correlation. And the equity rates have about a 20% correlation. So the point here is private real estate is a new asset class for you that has very little correlation to the rest of the program. So that's a plus. Next, if you go to page 9,
What do you see the interest rates doing to the real estate prices?
well, in theory, cap rates when cap rates go up, real estate prices are coming down. But you've got, as long as you've got a net operating income and divided by some value of the building, that's the cap rate. And if the demand continues to outstrip the availability of product and supply, the NOI will still remain pretty low. I mean, the cap rate will remain pretty low. This chart on the right bottom, the Sharpe ratio, is a measure of the return reward ratio between these different asset classes. So for every unit of risk, you have a unit of returns, and anything over 1 is favorable. You can see that since last 20 years, private real estate has had the highest compensation for risk of these asset classes, 1.06. And on the next chart to the left there, the graph, you can see the private real estate is off to the left. It's in the western side versus the S&P 500. Lower volatility is considerable, higher than bonds, but certainly a higher return profile than bonds. And then up at the top, you can see even going back 44 years, you can see where the returns have come from. And for the last 44 years, most of the returns have come from income in the last, let's say, 5 years, 3 years, and so forth. It's been about even split between appreciation and income.
So this is 20 years, so it takes into account 08 and 09 real estate.
It takes into account what?
08 and 09, the real estate crash.
Yes, it does.
Okay.
It does, yep. So let's talk about page 10. American Realty Advisors is a firm that we have presented to a number of clients for a long time, probably over 15 years now. I would say the real kickoff started in 2010, so it's been 12 years. One of their first clients they got in Florida was Port Orange Fire, and they're still there. We use about 5 of these firms. This isn't the only one, but due to the size of the mandate here, the other firms really aren't interested. They really want a much larger mandate. But we have some leverage with these people, and they agreed to take on the assignments, even though the sizes are below their stated minimums.
Their minimum is $1 million.
Huh?
Their minimum is $1 million, right?
What's it?
Their minimum is $1 million. Is that right?
Yeah, well, their minimum is higher than that. Does it say $1 million here?
I thought it
Where do you see $1 million in here?
In the original documents
Oh,
that
yeah,
were sent
I
out.
see it, $1 million, yeah. This plan has 7% allocation. I knew that when I just looked at the police, that 1%, 7% allocation would be right at 800,000. So that one was below the minimum. You meet the minimum, but it's the other 2 that didn't meet the minimum. Palatka Fire would require 640K, the police 860K, and both those plans would not have been eligible, but in this case, they are eligible. Because I asked them to make them eligible. Let's see, let's look at page 10. The net assets of this program, it's a big fund, about $6.8 billion. And the leverage is 18%, so it's very low leverage. You're like you buying a house for $100 and you only borrowed $18. The rest you put in is cash. So it's a very low risk proposition. There are 455 pension systems, 82 products or properties, I should say, and the leasing rate is 93%. So everything's stable, highly leased. You can see on the diversification, industrial and residential are the two largest. And they're the two strongest areas of the market right now. Office, believe it or not, is coming back. There hasn't been much office built in the last 10 years, 15 years. And office buildings are being repurposed. I'm going to go to Boston in about a month, and one of the projects I'm going to look at up there is it's an office building that's being repurposed into a multifamily building. So a lot of that's going on. Retail, believe it or not, is coming back. That's one reason why FedEx is having problems. That's one reason. People are not ordering as much from Amazon. Amazon canceled, I think, 40 proposed sites where they're going to put in logistics facilities. They've gone ahead and stopped that. They expect their growth profile to diminish here for a while as people are going out to the stores again. And Simon Property, which is the largest operator of malls in the United States, has reported nice sales increases, nice earnings. So there is something happening within the malls. Diversification is pretty widespread, 43% on the West Coast, 29% on the East Coast. This company built an office in Cambridge, Massachusetts, just across from Harvard Square. And its tenants are biotech. You know, Boston's a big biotech center. So they can be very particular where they invest in. Office kind of has a bad reputation right now, but really office is not. I think overall office is not a bad place. It's on the mend nationally. The replacement costs have gone through the roof. Block used to cost $1 a block, you know, building block. Not too long ago, it was $2 a block, and someone told me that today it's $2.70 a block. Rebar, wire, you can't even get a quote on a roof now if it's a commercial. If it's a big building, you can't get a quote.
We can get one. Trust me, we can get one.
But in cases where, let's say, the project is 1.5 years out, it's hard to get anybody to give you any number. In fact, they want the developer and the owner and the contractor to be at risk, frankly, with the end costs of roofing.
You ought to try to bid jobs out. Jonathan will tell you that you can bid a job out, and the bid you get, if you get it, you might as well throw away if you can't. You're not putting money to it right away, right? I mean,
so one of my clients is in Jacksonville. They have an apprenticeship school for iron workers, and they get these kids in. They pass a drug test. They get them started, and they last about a month. They get them, they get them on job sites while they're in the 3-year program. They're getting paid, $18, $20 an hour. And they just ghost the employer, the contractor, just don't show up. They just disappear. Don't call, they don't apologize, they just evaporate.
I thought this was supposed to make me feel better.
So we only have 33 minutes left.
But what I'm getting at is that investing.
Jonathan, only have 33 minutes left.
Investing in this pool, this program, I think, is a very good inflation hedge. These are not spec projects, or buying existing stabilized product around the country. And you saw that the two biggest weights are, industrial and residential, the two strongest areas in the market. They can't build apartments fast enough.
So
Go
do you
ahead.
mind if I just kind of share some of my observations?
Sure.
And I may ask you to confirm a few things.
Sure.
So first being, can you remind us what our percentage of portfolio allocation would be at 1.3 million for the general plan?
Well, 7%.
So 7% of all of our current assets as they're
Yes.
viewed would be going into this.
Yeah, it'd be
In real
about
estate.
$900,000.
Okay. I thought it was 1.3 for us. Is it 1.3?
Well, I'm sorry, I'm looking at the wrong figures. Yeah, 1.3, I apologize.
That number is fine with me.
It's 7%.
Yeah, I think that's probably really conservative. Just throwing that out there from my perspective. I noticed in their document that they said they held to a 35% debt to value ratio, but it was qualified as a voluntary threshold of 35%. So there are times when we could expect, if real estate took a dive from a valuation standpoint, that technically, if we were to look at it, our investment may have a higher percentage.
That's
of
true.
the
The
value.
denominator goes down and the numerator is fixed and you get a higher ratio.
And you said they're currently at 18%?
Yes.
Okay. 75% of the asset has to be leased up before they buy it. That's another voluntary criteria that I saw.
It sounds right. Yeah, this is not a value add proposition. They're going into fully stabilized core products.
And our investment will not be tied to specific assets because it's a pooled return, correct?
You have an undivided working interest in all of those properties. So
Mutual fund.
you're not
What it
buying,
amounts to, it's mutual fund type thing.
yeah, you're not getting in, if they're buying some warehouses out in Nevada, that's not what we're doing. We're in the entire pool.
Okay.
We're with everybody else.
All right. Thank you for the clarification. The other thing I noticed was that they will and can use other investments from time to time, be it money market accounts, CDs, issue loans, so that the entirety of our investment is not guaranteed to be tied to actual physical assets. Is that correct?
It is, and if they do that, they're going to advise you. A letter would go out letting us know and letting you know that they have ventured into some areas that are that were previously disclosed that they had the ability to do so. And let me add that there are 4 windows a year to get in and 4 to get out. So if for whatever reason we felt uncomfortable and we wanted to get out, we could start the redemption process.
And if we get out, our valuation for our percentage is for that period when we notify them. So we're not guaranteed to get. So how quickly would we get notice from them if they change their asset allocation?
Well, if it was something, I mean, money market's not a big deal, but let's say to answer your question, you would, if they're doing something like that in a not in a nominal way, but in a measurable way, they would send a letter out to us. We'd all get the letter. Council would get the letter. We'd talk about it. But I've been with these guys for a long time and they haven't done anything slick.
So that property diversification pie chart right there, when it says industrial or residential, does that percentage reflect actual assets owned, or does that reflect assets and loan instruments issued against those assets?
Yeah, I see what you're asking. That's a good question. It's not footnoted unless it's in the very back. But because the leverage is so small, I don't think it's that big. It would make that much difference. It's only 18% leverage.
But you know them as primarily investing in fixed assets, cash flowing assets, and appreciating assets.
Yeah, they don't invest in dirt. They don't buy developmental property.
Mhm.
Um,
I mean, it's just one concern of mine not seeing that, but I'm in support of it.
No, that's a good, these are all good questions. They have been vetted for a long time now. I mean, we've actually had a working relationship with them for 12 years, and they've been very consistent. I thought in 2000, actually it was before 2010, because a number of these funds in 2010 put gates up. Remember 2010 was a period when a lot of plans were trying to rebalance because their stocks had gone down so much.
All I was worried about was getting a job. I was just out of college.
Okay. And they,
Yeah, I did, and I'm happy with it.
and they, a number of pension systems were trying to get money out of these private real estate programs because they wanted to get some liquidity to put back into the depressed stocks. And put up a number of these programs put gates up and restricted. So let's say for every $100 you requested, they only give you 10. We never really had that issue with these guys. They were pretty responsible. And I think that we're not retail, investors. We're not trying to, play the market every day. This is a long-term proposition. So the types of investors they have just ride through those down periods and aren't trying to redeem out.
I didn't
Actually,
see.
it's a good time to add, actually.
Yeah, well, I think we're a little late to the game actually, but
And we could be in a later inning, but I don't think the game's over for you guys.
no, I don't think so either. I just think, so the other thing is I didn't see in there, and it was a long document. I didn't get to read the whole thing, but do they have a limitation on how much they can sell or how much they can acquire so as to give us some sort of sense that they're not gambling or speculating on the rising appreciating values of property and they're looking for actual cash flowing assets?
Yeah, that's a good question. Here's what I know. Right now, they have money in the queue to get in. I don't know if they'll take all this or not at once. They may take only a portion of it. It may take us 2 or 3 quarters to get in fully. So what that tells me is that they are very careful. They are not just running around putting money out as fast as they can. They are very careful. And the market, one of the things that they've done as they've grown is they've tried to thin out some of the, let's say, smaller properties that they bought years ago, legacy properties. And they're trying to buy into some higher quality stuff, let's say in the Denver area or the Austin area or the Raleigh-Durham area. So there's sort of rotation and shifting. I think to answer your question, I think they're really trying to make the portfolio of higher quality and not run around and buy whatever they can buy. It's cheap.
What did everybody else think?
Huh?
What did y'all think?
You're recommending this because it gives some stability, some.
Yes, it's not, the valuations are not mark to market like the stock market and the bond market. You see a much steadier, you can see that scattergram where everything's off to the left side. It's a steadier to stabilizer. It's an inflation hedge and it's low leverage.
Burgess, this is Levinson. Can you hear me?
You're invested in a lot more real estate right now. Do you see that as a better investment?
Yes, good investment.
Who is it that's trying to talk?
I think it's your attorney.
Burgess, I'm just wondering if you can talk real quick about the appraisal process, because that relates to, I think, a question that I just heard.
Okay, good question. So in lieu of pricing value in these properties daily or weekly. They use a third-party service that essentially takes American Realty's internal valuation metrics. It may be some cash flow multiplier, maybe some whatever. And they take that information and they verify it. And they do that throughout the year. So there's kind of a staggered process, but throughout the entire year, all the properties are reappraised.
But they're paying for the appraisal.
You know, yeah, it's all a part of their expenses.
But no, my point is, you know, if you're getting an appraisal and you get to pick the appraiser, there's a little bit of preference that goes into that. So, and you
Is that
know,
what MAI stands for? Made as instructed? I think they do. I think they do a fair job.
I mean,
Well,
I'm being
from-
critical, but I'm supportive of moving into this asset.
But from my perspective, I'm not going to try to sit here and critique the particular firm that we're talking about using or the fund. I mean, if we don't trust you to do that, then we probably need to get somebody else to handle this. I don't have the information, probably don't have the expertise either to talk about the particular people that you're dealing with. If you're recommending this agreement to us, and I guess that's where we are, I guess we have moved to 3A, the real estate investment agreement and side letter. So if that's where we are at and that's what you're asking, then the agreement, I guess, is the ARA Core Property Fund LP agreement. Is that what we're talking about? Has everyone, so let's go ahead. It's on the topic. It's on the board. Have all of you had an opportunity to look at it? Is anyone at a point where they're willing to make a motion as far as our entry into this agreement?
I'm willing to make a motion.
All right,
I'll second it.
Okay.
what's the motion?
I move that we accept and authorize the agreement with, forget the acronym. Thank you, Joe.
Okay,
Second,
I guess.
is there any discussion? So that motion would be, then include authorization from me as chairman to sign as subscriber on the agreement that was in our packet. Any more discussion? All in favor, say aye. Any opposed? And I'm signing that right now.
How often will we get reports from them?
You'll get our report too will include their results.
I've signed the agreement. I'm gonna give it to.
And I think they will come. They will come to these meetings. I tried to get Rochelle to come to this one and she had a conflict, but her office is in Lake Mary, not too far away.
Okay, so we've signed the agreement, as Jonathan pointed out. We're about 20 minutes away from having to vacate the room.
One more thing you have to do.
What's that?
You have to authorize establishing a 7% position in the fund.
Okay,
So move.
discussion? All in favor, say aye.
Aye.
Show it as unanimous.
Before you sit down, could you also speak real quick, and this is Levinson on the screen, about the side letter, or do you want me to do that?
It's all done. Yeah, I guess that's a good idea. They're running out of time. They only have about 15 minutes, so give a skinny on why you had to do a side letter.
So trustees, there are, as you may have heard, a good number of plans in Florida that use real estate. And because these are complex contractual arrangements and they're drafted by their attorney, what you want to have, which is what we do, is we try to give you some legal protections separate and apart from what the contract says. And we're not going to be reinventing the wheel because we have so many clients that either use American Realty or use other real estate managers that are similar. So in addition to the agreement that the chair is going to be signing and maybe even sign during the meeting, there's also going to be this side agreement, which is going to be a couple pages. It's all legalese. And that's a way to try to take back some of the legal rights that we're giving up, if you will, in their underlying contract. So that's something else you'll be getting a copy of. And by the way, the other board that met right before you also agreed to use American Realty. So it's basically the same agreement that they're going to be signing, which is to protect you. So that's just a quick high-level summary of that item on the agenda, which is side letter.
Okay, so the question then would be whether or not the board would be in favor of me on behalf of the board executing the side letter.
So it's part of the contract execution process, and it's fully in your advantage to do that. And that is our recommendation. And Burgess, you want to talk to that real quick?
Anybody want to make the motion?
Motion to accept.
Discussion? All in favor?
Aye.
Any opposed? Show unanimous again. I signed it. Thank you, Jill. Okay, now, have we already done the quarterly reports?
You already did.
Thought we did.
That was the good news.
Yeah. Ms.
How-
Parrish, who is not Ms. Parrish, do you,
However, it wasn't accepted. You didn't make a motion.
can we reject it? I move reject it until Mr. Chambers, he needs to come back with better news, or we're not accepting it. How's that? Anybody second that motion?
No.
Okay, then if that's not the case, does anyone want to move to accept his report?
Accept the
I'm
report, you
with
don't
you.
just acknowledge it, you know?
I'm not sure either, but
But I'll make a motion, we accept the report.
anybody? Brett, you want a second for a change? I mean,
I'll second that motion. Thank you.
okay. We got a motion and a second to accept Mr. Chambers' report instead of telling him that he's full of prunes and we don't want to listen to him anymore. So anybody have discussion about that? All in favor?
Aye.
Any opposed? All right. You've got an unqualified endorsement on your report then, Mr. Chambers.
Thank you for your report.
Thank you.
So I'm sorry, I missed the gentleman's name who's sitting in for Miss Parrish.
Sure. This is
Thank you.
Attorney Adam Levinson. It is nice.
Mr.
to see you.
Levinson, did you have anything you wish to add at this point under item 4, which would be your report?
Sure, real quick, because I know you're pressed for time, but it's a pleasure to see all the trustees. Anna sends her regards. So this time of year, because the deadline has already passed, I want to make sure if I were in the room with you, that everyone would nod your head to say that, yes, you did your Form 1 disclosures. And if you have no idea what I'm talking about, then you should give me a call or give Anna a call. But that's just a quick reminder, everyone, the Form 1 disclosures. I'm also going to point out to you as an informational item that the contract for your actuaries has been reviewed and that's good to go. So that's just a quick informational item. I heard one of the trustees mention that the minimum wage has gone up at the end of the month. That is correct. It goes up and will continue going up every year until it hits $15. And that's just because somebody mentioned it. And the last thing is, now that you're going to be investing in real estate within the next couple months, I'm not sure the last time trustees went to any of the conferences. And if you see me at any of the conferences, come by and say hello, the FPPTA or any of the other conferences. But there are other boards that have been investing in real estate for a while, and you're going to see lots of real estate managers there. So these are things that you can talk about at conferences. And the last point I wanted to make, and I think everybody knows this, when Burgess tells you that he's recommending an asset, Burgess is a fiduciary. He's looking out for the best interests of his clients. And that is why he's not making any commissions or any additional benefit to him. He's looking out for the best interests of his clients. That's why he is a fiduciary, as are we. So that concludes the attorney's report, unless there are any other questions.
He shouldn't tell me he's looking out for my best interest and tell me he's building a house in Savannah at the same time. Okay, quarterly expenditures.
Quarterly expenditures are up on the screen, nothing unusual.
Anybody in reviewing the quarterly expenditures, does anybody have any question? We still have some money as long as Mr. Bush doesn't take his out. We're in good shape.
It'll all be gone pretty soon.
Anybody have any questions? If not, I guess you want me to have a motion to accept the quarterly expenditure report. Is that correct?
Yes.
I'll make a motion to accept the report.
Second.
Any discussion? All in favor?
Aye.
Aye, unanimous. Public comments. We have some folks who walked into the back of the room thinking they're coming to a Historic Preservation Board meeting and probably have no idea what we're talking about. So, but I assume you don't have comments, but if you do, you're welcome to make any comments that you have. Somehow I assumed that. Okay, any other business come for the board?
Yes, there is. You all have a printout of dates for the calendar year 2023. The dates are here at this meeting just for informational purposes, so that if you have any conflicts with these dates, you can let me know. Burgess and Patrick, the actuary, and Dwayne Madden, who is part of the other two pension boards, have agreed on these dates. They are a month earlier, or at least 3 weeks earlier than usual. And this is to help with when we don't get a quorum and we have to be within the quarter. There isn't such stress on us to find times in the last week of the quarter. So we're bringing them back about a month. And it also gives this real estate fund. We have to let them know 2 weeks in advance before the end of the quarter to make adjustments. So it serves two purposes.
Okay, so our next meeting would be February 28th.
Actually, the next meeting is December 13th, but these are the dates for 2023, which I'll bring these dates for a vote in December 13th meeting.
Okay, do you need us to confirm those, or will you
No,
just?
if you have any major conflicts that, this is for all the boards. So I'm letting all the boards know in advance of this kind of change.
Okay. All right. Anything else anyone else wants to bring? In all seriousness, Mr. Chambers, we do appreciate your information and understand that you're the messenger and that my kidding you about the message was just that, kidding you.
I understand. I
So
don't blame you.
I assume that you understood. I didn't think you would be
No.
in your business. I didn't think your skin could be that thin that you would take that seriously and go into a state of depression. But just so that I'm clear on that, we do appreciate all you have done for us and are doing for us. And as Paul Harvey used to say, I never forget, back in one of these recessions or downturns or whatever, he came out with his normal way of putting things and said, just remember, the only one to get hurt on a runaway train is the person who jumps off before it stops. And not that I'm any expert on the stock market or the bond market or anything else, but it sure seems that when you're in where we are right now, trying to jump out, find a time to get out back in
Well,
requires a heck of a crystal ball.
the only way I can sleep at night is knowing that we're doing the very best we can. Now, that does not prevent me from waking up at 4. You know what those nights are like.
I do, as a matter of fact. Okay, if we don't have anything else, Miss Tammy, do you have anything you want to bring? Mr. Dennis? You good?
Yeah.
Okay. Jonathan? And we'll declare the meeting adjourned.
Thank you, everybody.